Imagine waking up tomorrow and seeing a number so large that your brain almost refuses to understand it. More than $40 trillion. That's the scale of America's national debt. But here's the part most people don't understand. The biggest danger isn't simply the number. It's the interest. Because when the cost of borrowing rises, America doesn't just have to pay for today's spending. It has to pay more for yesterday's borrowing. And at the same time, America is entering another massive spending cycle. Artificial intelligence, data centers, semiconductors, cloud infrastructure, energy, billions and potentially trillions flowing into the technology of the future. So here's the question. What happens when America's $40 trillion debt problem meets the AI spending boom? Let's start with the debt. The United States has accumulated more than $40 trillion in national debt. And it's easy to look at that number and simply say, that's a lot of money. But that's not the sophisticated way to look at debt. The real question is, how much does that debt cost to maintain? Think about your own finances. If you borrow money at a low interest rate, the payment may be manageable. But if the interest rate suddenly becomes much higher, the same debt becomes far more expensive. The U.S. government faces a similar mathematical problem. When older government debt matures, it has to be refinanced. And if the new interest rate is higher, the government's interest bill rises. That means more federal revenue can go toward interest payments instead of other priorities. And that's why investors don't just watch the national debt. They watch Treasury yields. Here's something every investor should understand. Treasury yields aren't just numbers on a financial website. They influence the price of money across the economy. Mortgage rates, corporate loans, credit, business investment, stock valuations, and even the return investors expect from riskier assets. Why? Because U.S. government debt is widely treated as a benchmark for relatively low-risk, dollar-denominated borrowing. So when Treasury yields rise, other borrowers often have to offer investors higher returns too. That can make borrowing more expensive for almost everyone. And when America is already carrying an enormous debt load, higher borrowing costs become increasingly important. But now, we need to add another piece to this puzzle. Artificial intelligence. AI isn't just a technology story anymore. It's becoming one of the biggest capital spending stories in modern business. Think about what AI actually requires. Massive data centers, advanced chips, servers, cooling systems, electricity, fiber networks, cloud infrastructure, real estate, construction. And all of it costs money. A lot of money. Recent reporting has highlighted a dramatic increase in corporate borrowing connected to AI infrastructure. Reuters reported that AI-related corporate debt issuance reached roughly $220 billion in 2026, compared with about $12 billion during the comparable period a year earlier. That's an enormous change. And it raises an important question. If companies are borrowing huge amounts of money to build the AI infrastructure of tomorrow, what happens if the returns don't arrive as quickly as expected? Because debt doesn't care about hype. Debt still has to be paid. Now let's talk about something called crowding out. Imagine there is a giant pool of investment capital. The U.S. government wants to borrow from that pool. Corporations want to borrow from it. Technology companies want to borrow from it. AI infrastructure companies want to borrow from it. Everyone wants capital. But capital isn't infinite. If demand for borrowing increases, investors may demand higher returns, and higher required returns can mean higher borrowing costs. This is one reason investors are paying attention to the growing overlap between government borrowing and corporate borrowing. The United States is borrowing, big tech is borrowing, AI companies are borrowing, and investors are asking, how much debt can the market absorb? Now we arrive at perhaps the most important player in the entire story, the Federal Reserve. The Fed's job isn't simply to make stocks go up. Its monetary policy is designed around things like inflation and employment, while financial conditions affect the broader economy. And here's the difficult part. If inflation remains too high, interest rates may need to remain restrictive. But higher rates make borrowing more expensive, and that creates a complicated situation for a heavily indebted government. Recent U.S. inflation data showed annual PCE inflation around 3.7% in July, still above the Federal Reserve's 2% target. So investors are watching every inflation report, every jobs report, every Fed statement, and every Treasury auction. Because 1 percentage point on a $1 trillion debt balance isn't pocket change. It's billions of dollars. But don't make the mistake of turning this into a simple disaster story. That's not how serious financial analysis works. America still has enormous economic strengths. The world's deepest capital markets, a powerful technology sector, a highly productive corporate economy, a globally important currency, and some of the most valuable companies on Earth. In fact, recent reporting has highlighted strong corporate profitability, even while concerns about U.S. government finances remain elevated. That's the paradox. The private sector can be incredibly profitable, while government finances become increasingly difficult. America can have strong companies, strong innovation, and still face a long-term fiscal challenge. Both things can be true at the same time. Now comes the question investors really want answered. Is AI a bubble? Maybe. But that's actually the wrong question. The smarter question is, are investors paying too much for the growth they're expecting? Because AI can completely transform the economy, and some AI investments can still lose money. Those two statements aren't contradictory. Think about the internet. The technology changed the world, but that didn't mean every internet company was a good investment. The same principle applies to AI. The technology may be revolutionary, but investors still need to ask, how much revenue will it generate? How much profit? How quickly? And how much debt is required to build the infrastructure? Innovation is not the same thing as a guaranteed return. So what should investors actually watch? 4 things. Number 1, inflation. If inflation remains stubborn, the Fed may have less room to cut rates. Number 2, Treasury yields. If long-term yields remain elevated, government and corporate borrowing costs can stay under pressure. Number 3, AI returns. Companies are spending enormous amounts on AI infrastructure. Eventually, investors will demand evidence that those investments generate meaningful economic returns. Number 4, confidence. Because financial markets aren't powered by mathematics alone. They're powered by confidence. And when confidence changes, markets can change very quickly. So here's the real warning. America doesn't have a crisis simply because it has debt. Debt can be productive. Borrowing can finance infrastructure, innovation, businesses, economic growth. The problem begins when the cost of servicing debt keeps rising, while economic growth isn't strong enough to comfortably support that burden. That's the line investors are watching. And that's why the Treasury market, the Federal Reserve, and the AI investment boom matter far beyond Wall Street. So the next time you hear, the stock market is going up, don't stop there. Ask why. What are Treasury yields doing? What is inflation doing? How much debt is being created? How much money is flowing into AI? And most importantly, who is paying for the growth? Because the biggest financial stories aren't always hiding inside a stock chart. Sometimes they're hiding inside the bond market. And if America's debt, the Federal Reserve, and the AI boom collide at the wrong moment, the consequences won't stay on Wall Street. They could reach every American wallet. If you want more powerful financial stories, market analysis, and the hidden forces shaping America's economy, subscribe to Official Shake Your Shot. Because here, we don't just follow the headlines. We look at what's happening underneath them. Subscribe to Official Shake Your Shot and stay ahead of the next big financial story.